You are staring at the screen, the candle is turning red. You bought the breakout because the setup looked perfect. Every indicator aligned, the momentum was there. But now it is dropping. First, just a little. You tell yourself it is a normal pullback. Then it drops more, your heart rate ticks up. You start bargaining with the market, just get back to break even. But it does not go back. It breaks the support level. It breaks your stop loss, but you already moved your stop loss. Now you are down, you are trapped. So you do the worst thing possible. You average down. The market closes. You stare at a massive red number. You feel sick. You feel stupid. The market does not know who you are. The market does not care. The market is not hunting you. You are hunting yourself. 95% of traders lose money. Your ego tells you that you are different. You make a little money for 3 weeks, then give it all back in 2 hours. The market is not a puzzle to be solved. It is a mirror. Trading is a zero-sum game. The 5% take from the 95%. Let us start with what the masses get completely wrong. The average retail trader approaches the market based on intuition and biological instinct. Human beings are hardwired to avoid pain and seek immediate gratification. When a trade goes against you, it registers in your brain as physical pain. To avoid that pain, you refuse to take the loss. Conversely, when a trade goes in your favor, you feel fear the market will take profits away. So, you sell early, you take a tiny profit. What does this create? It creates a mathematical disaster. You are capping your winners and letting your losers run. This is the exact opposite of what every profitable trading book tells you to do. Let me show you why this intuition destroys accounts. We need to look at the math of ruin. Let us say you start with an account of $10,000. You lose 50% and now you are sitting at $5,000. The amateur thinks they just need to make 50% to get back. That is mathematically false. To get back to $10,000, you must make a 100% return. This is why risk management is the foundation of survival. The 5% protect their capital. The 95% focus on what they can make rather than what they can lose. You must unlearn the desire to be right. The 95% are obsessed with prediction. They convince themselves they have a crystal ball. They need the trade to win to validate their ego and analysis. Here is what nobody tells you about the 5%. The 5% do not predict anything. They do not know what the market is going to do next. They operate entirely on edge. An edge is simply a higher probability of one thing happening over another. If your strategy wins 60% of the time and pays $2 for every one risked, you have a massive edge. But you cannot predict which trades will win and which will lose. Think about a casino. The casino does not care if you win the next hand, because the mathematical edge is built into the game. Over thousands of hands, the casino extracts money from players. The 5% treat trading like the casino treats blackjack. The 95% treat the market like gamblers hoping to get lucky. The biggest problem is the gap between theory and live execution. Everyone can backtest a strategy when the chart is static. It looks simple when the market is closed, but live execution is chaotic and stressful. In real time, your brain processes a million variables. The 95% freeze and second-guess their strategy. By the time they enter, the move is already halfway done. Or they exit early in panic, only to watch the market reverse and hit the profit target. To fix this, you have to make the second major shift. You must stop judging your success trade by trade. The outcome of any single trade is completely random. The outcome of your next trade is completely random, regardless of the setup. The 5% judge their performance over a block of trades. An edge reveals itself over a large sample size. The 95% try a new strategy on Monday. They take 3 trades and all 3 lose. They immediately declare the strategy a scam. Then they search YouTube for a new holy grail indicator. They jump from system to system, never accumulating enough sample size. You must unlearn the employee mindset. As an employee, an hour of work equals an hour of pay. In trading, you can do everything right and still lose money. You can also make terrible decisions and still make money. This disconnect breaks the minds of the 95%. The 5% focus on flawless execution of their edge. Common advice like manage risk lacks context. Managing risk without an edge is just bleeding slowly. It becomes death by 1,000 paper cuts. Risk management is the shield. Your edge is the sword. You cannot win a war with just a shield. Then you have the concept of risk-to-reward ratios. You are told to always aim for a 1 to 3 risk to reward. If you risk $500, you aim to make 1.5 thousand. On paper, this sounds amazing. You only need to win 25% of trades to break even. But forcing high risk to reward targets causes problems. The market does not care about your arbitrary targets. You watch winning trades reverse and hit your stop. The 5% read the market structure. They take trades where the market structure aligns with positive expectancy. If the setup does not offer a favorable profile, they do not take the trade. They simply sit on their hands. Boredom is one of the biggest account killers. The 95% feel they must always be in a trade. If they are not in a trade, they feel like they are missing out. They stare at charts for hours while the market moves sideways. Their brain starts hallucinating setups. They enter a low probability trade for the dopamine rush. The 5% trade like snipers. A sniper waits for a single high probability shot. Professionals understand that cash is a position. Protecting mental capital is as important as financial capital. Boredom trades drain your mental energy. When the real setup appears, you are too exhausted to execute. Another hidden variable is slippage and spread, the frictional costs of trading. Amateurs backtest scalping strategies for tiny moves. They ignore spread and commission eating their profits. In live markets, they get hit with massive slippage. They wonder why live results differ from paper trading. Professionals account for every frictional cost. They understand market mechanics, order routing, and liquidity. They know where stops are resting. Institutions push price to grab liquidity before moving the market. To survive this, you must move from discretionary to systematic trading. Discretionary trading means subjective decisions based on feeling. Without experience and emotional control, it destroys traders. Your discretion gets hijacked by emotions. The 95% operate on feelings. The 5% operate on strict mechanical systems. A system removes decision-making pressure. Your plan should be a checklist simple enough for a child. Are prices above the 200 moving average? Yes or no? Has the volume oscillator crossed the threshold? Did the candle close above the previous high? If any rule fails, you do nothing. There is no guessing, only system execution. You must stop seeing yourself as a market wizard. Start seeing yourself as a risk manager and system executor. Let us dive deeper into the psychological abyss that separates winners from losers. When you take a loss, your ego is bruised. The amateur takes the loss personally. They feel like the market insulted their intelligence. What follows is revenge trading. The amateur immediately looks for another trade to win the money back. They increase their position size. They abandon their rules and operate on anger and adrenaline. This is when accounts go from drawdown to completely blown. You lose $200 on a trade you knew you should not take. Instead of walking away, you double your position size. The next trade goes against you too. Now you are down $600. Panic sets in and the rational brain shuts down. You are no longer trading, you are throwing money into a fire. Professionals have a completely different response to loss. They pre-accept the risk before entering the trade. The risk becomes the cost of doing business. Losing trades are inventory for finding winners. If a loss makes your hands sweat, your position size is too big. The 5% size positions small enough to stay calm. They can lose 5 times in a row and still execute perfectly. The 95% sweat on trade number 1, trying to get rich fast. Traders lean toward the screen trying to control the candle. You have absolutely zero control over the market. The market is made of millions of participants, algorithms, and global events. You are a single drop of water in an ocean. You cannot dictate where the tide goes. The only thing you can control is yourself. You control your entry, stop loss, position size, and exit. Once you are in a trade, you are a passenger. The 5% surrender to the market. They set their parameters and let the market do its thing. Moving your stop loss is refusing to accept a loss. It turns a 1% risk into a 5% risk. Eventually, it turns into a margin call. We must confront the myth of the Holy Grail. The retail industry sells shortcuts. Traders search for the perfect indicator combination. Indicators are just representations of past price. They cannot predict the future. Professionals rely on structure, price action, and supply and demand. They can trade with just a blank chart and horizontal lines. The Holy Grail is not an indicator. The Holy Grail is discipline. It is executing a boring, repeatable process every day, without deviation, regardless of how you feel. Let me walk you through the typical life cycle of the 95%. They start in phase 1. They do not know what they do not know. They open an account and buy random stocks from social media. Sometimes they actually make money. This beginner's luck wires their brain to think trading is easy. Then the market shifts and they lose the money. They enter phase 2 and realize trading is hard. They start hunting for strategies. They try breakout strategies, mean reversion, and smart money concepts. They lose again and again. They constantly change variables and never build data. They look for a strategy that never loses. When a strategy hits a drawdown, they abandon it. The 5% reach phase 3 and realize they are the problem. They pick one strategy and commit to it. They backtest it over years of data. They know the win rate and reward ratio. They know the maximum losing streak. Because they know the numbers, they do not panic. They simply keep executing the plan. Eventually, they reach phase 4, where trading becomes boring. There is no adrenaline rush anymore. It becomes a routine of executing checklists and journaling trades. They clock in, execute the system, and clock out. There is a massive misconception that profitable strategies must be complex. Amateurs create charts that look like abstract paintings. They believe complexity equals sophistication. The 5% strip everything away. Complexity is the enemy of execution. The brain cannot process many signals under pressure. Too many signals create analysis paralysis. The most profitable strategies are often simple. Buy when price breaks the daily high. Place the stop at the daily low. Trail the stop as the trade moves. The magic is not complexity, but robotic execution. Execution over a massive sample size creates profitability. A losing trader can ruin a profitable strategy. They enter too early out of fear of missing out. They exit too late out of greed. They tweak the parameters of the system. Professionals extract profit through risk management and sizing. Professionals guarantee execution by tracking everything. The 95% do not journal their trades. After a loss, they want to forget it. They close the laptop and pretend it never happened. The 5% treat their trading journal like a sacred text. Every single trade is recorded. Entry price, exit price, time of day, setup criteria, emotions. They review this data obsessively because data removes emotion. Data reveals patterns in performance. For example, Tuesday win rate 20%, Thursday 65%. This gives actionable decisions. Data exposes your bad habits. You cannot improve what you do not measure. Without a journal, you are gambling. You are blindly throwing darts in the dark. Professionals run trading like a business. Inventory, overhead, profit margins, data analysis. Mastery of markets is not fighting hedge funds. The real battle is against yourself. Trading is a repeatable process exploiting an edge. You must destroy your ego and instincts. Adopt the mindset of a casino operator. You must accept losing money sometimes. There will be losing days, weeks, and months. That is the cost of admission. The 5% win because they know how to lose. They lose small, systematically, and without emotion. The ultimate goal is not learning a new setup. The goal is a complete identity change. You must kill the part of you that wants to be right. The part that wants excitement and quick riches. You must become a disciplined executor of probabilities, crossing the chasm from the 95% to the 5%. You are tired of the emotional roller coaster. You are ready to treat trading like a profession. Take a hard look at your own trading. What psychological trap keeps blowing up your account? Is it moving your stop loss? Is it revenge trading? Is it forcing trades out of boredom? Write the habit you struggle with most. Acknowledging it is the first step to destroying it. If this breakdown shifted your perspective, leave, so more traders see it. Subscribe for more trading breakdowns. Stop gambling, start executing. Keep your risk tight. Keep your mind cold. See you in the next one.